Hi, good afternoon and welcome to CNBC TV18's Mumbai newsroom. I'm Sumaira Abdi and you're watching Your Stocks. Joining in today, we have our two experts, Vijay Chopra of EnochVentures.com and Ashish Kyal, CMT and author at Wave Strategy Advisors. Gentlemen, good afternoon to both of you and thanks very much for joining in. We have our first caller who's connected with us already from Mumbai. Samir Shah calls in. Hi, Samir. Good afternoon. What is your question for us today? Samir, can you hear us?
Yeah, I can hear you. Can you hear me?
Yes, I can. Go ahead.
Yeah. So my query is regarding, I have 50 shares of Tata Power at 241, and I would like to know, shall I hold these stocks for a more short, for a long-term purpose, or and accumulate if any other further dips are there? And just want to know what are the long-term perspectives for it.
Is this a recent investment?
Yes.
Then Samir, I will caution you, or rather, you should have sought this advice before you bought in, right? Now you have already purchased. But anyway, let's get your long-term view on this. Vijay, Tata Power, a good buy for Samir?
Well, yes, definitely it is. I think that, the stock has corrected a bit in a couple of days, but this doesn't mean that, there's some problem with the stock. I think that, the power play is going to be here for some time, at least for the next 4-5 years until we see the EV thing completely rolling out and panning out. And Tata Power is a forward and backward integrated company. So while Tata Motors is making EVs, Tata Power is setting up a lot of EV charging stations across the country. And I think that, all the major power players, whether it's Tata Power or Adani Power or Power Grid or, companies like this, all the power trading platforms, they're going to do stupendously well in the next coming 3 to 5 years' time. So Tata Power is a hold and no need to sell. I see an immediate target of close to 300 coming, but again, if somebody holds with a longer term perspective, I think that it can touch 500, 550 as well.
Okay, that's the long-term view. Let's also get in Ashish to tell us where the stock could be headed. Ashish, what's your target on Tata Power?
See, the overall stock is given a very good breakout on the upside after a correction that we saw towards the level of 190 and consolidated for some time and given a positive breakout. So I think the support is on the downside is at 220 over the near term. And on the upside, I'm expecting a target of 290, which is the previous high. So continue to hold on. Stock looks good, but consolidating. So over short term, we can see some consolidation continuing here. But eventually, it should head higher towards 290 or possibly much higher than that.
All right. Samir, I hope that advice works for you. Next up, we have a query from Kolkata. Arjya Roy has written in. She says she's a long-term investor and wants to buy shares in Concor. So this is on the recent news development and wants to know whether it is wise to make investments now, given the market volatility. So Vijay, this market volatility is, in the minds of a lot of investors because the mutual fund data came in today. And despite, most funds doing so well, the inflows are reducing. And, this is the same that we are seeing with the stock market investors as well. Right now, people want to make investments. There are opportunities available, but they're scared if this is the right time. So this market timing seems to always creep in to the minds of retail investors. What is your advice on Concor and in general about trying to time the market?
Sumaira, I was going through some data and what I read was that India's earnings to GDP ratio is the highest. And when such things happen, I think that markets are in for a big run-up. And definitely, I won't say about retail because retail generally is a laggard. They follow. They are not the ones who are going to start the game, but they would follow. And I'm sure that once the markets start moving up, definitely there has been some volatility February onwards, where we saw a war and then we saw major corrections happening. The stock markets also going down to 15,100 or so. But I think that markets are here for the long haul. I think there are certain sectors which look very, very good due to the war. I think that there's a huge potential coming up because the world is looking at India for a lot of things. They don't want to go to China. So the China plus one policy is getting into play, and Indian companies are going to be major beneficiaries because people will not go to China where else they would go. So India is, I think, at a very sweet spot. So don't worry at all. I would just like to, tell the retail investors through your channel that don't worry. These are great times to invest. I was also going through some technical charts of Nifty, and I see Nifty, what I'm trying to, see and understand is that there might be a golden crossover very soon in the Nifty, on the Nifty charts. This means that Nifty is going to run up and all the Nifty stocks are going to run up. I see huge potential in metals. I see huge potential in IT, chemicals, specialty chemicals, paper, and fertilizers, so there are lots and lots of good sectors, good companies to invest. So don't worry, keep on investing, keep on nibbling. And as far as Concor goes, great company. Already it has run up a bit. I think that, you should wait for a correction. If somebody gets it around maybe 700 or 690, it would be a great time to enter. If India has to grow, logistics is an integral part of the national growth story. Concor is kind of a backbone because it has very good terminals across the country, with lots of railway stations and lot of rakes, and I think that Concor is a great company, and the government is also trying to divest this company. So I think that in a correction you should buy. No point of getting into it right now, but wait for a correction.
Okay, well said, Vijay. Ashish, what about you? Your take on Concor and anything you might want to add with respect to people wanting to know if there's market volatility ahead?
See, Sumira, the way I see it is that whenever there is volatility in the market, people tend to shy away from that. We can clearly expect the majority of the retailers who ended up selling their stocks, holdings, and mutual funds were the one who sold it in the crash of March 2020 when it was near around 8,000, 9,000, and many are trying to get up when it already rallied. So that mindset has to change. One has to understand that if you want to make a higher return, the risk is going to be there, but risk-adjusted return is always higher. If you look at the CAGR of sensex or nifty over the past 20, 30 years, we can see that it has always beaten down every other, asset that we can look at. So having said that, if your time horizon is from 3 years, 2 years, 5 years perspective, then you should not shy away from the market. The volatility is going to stay here. That's the reason why people are scared, because you are looking at overnight gains. But for that, you have to do a short-term trading. So for long-term investment, continue to invest in the markets. Dips, use that as a buying opportunity. That is what I would say. Do not worry about what's happening globally. India as a whole has a good domestic consumption. We can clearly see how we emerged from the lower levels on the upside. But yes, use that dips as a buying opportunity. Don't end up buying near the top, but use any correction as a buying opportunity. Now, as far as Container Corporation is concerned, the stock has given a very good breakout from the levels of 721. One thing is sure, that you should buy the rumors and sell the news. That is what is a famous Wall Street adage that goes around, and that is true for every stock as well. So now, since the news is out, I would wait for dips to buy. So if you get any kind of dip around that 740, 730 mark, rather 730 mark on the downside, you can buy this stock, maintain a stop loss of 680 on the downside, expecting a target of around 800 or much higher level.
Okay. And, I just want to also add that I had read this very, very interesting report by Morningstar India, where they had sort of analyzed the market data for the last 10 years. And they, sort of calculated all the days on which the market rallied, and collectively it accounted for just about 7-8% of the decade. So if you weren't invested, if you were trying to catch that rally by sort of trying to time, you would have missed it for sure. The only way to get around it is to remain invested. So just to show that, very, very few days are actually what make up for that rally, and it's very difficult to try and time that. Even experts find it difficult. Okay, next query comes in from Diana D'Souza, who has written in from Mumbai. She has 5,000 shares of Morpin Labs, bought at 52, and 1,000 shares of Dishman Carbogen at 145. She's making losses and wants to know what she should do, remain invested or exit. Ashish?
See, if you look at Morpin Labs, we can clearly see stock has been in a downtrend for quite some time. It's in a secular downtrend, to be honest. But right now we are seeing some kind of basing formation here. So if it manages to cross that 36 mark, we can expect it to go towards that 40 level. So I would suggest continue to hold on to the stock right now. And for the target of 40 on the upside, do not expect it to, go towards your cost price. I think 52 is the cost. Immediately, it will take a lot of time. And on the downside, the support is at around 32. So hold on with 32 as a stop on the stock. And as far as Dishman Carbogen is concerned, again, we can see a very strong, we can see the stock has been very weak. The correction started from 250 levels, stock is trading at around 117. The plus is that after forming a low around 100, it is managing to sustain that, not trying to retest that low again. So there is a possibility we might start seeing some basing and an upside rally can resume from here. Also, important note is that small cap index is still far away from its all-time high, substantially far away, where Nifty is not much away. So small cap, mid cap stocks are yet to catch up. When that happens, these stocks will also rally. So I think continue to hold on to Dishman Carbogen, but maintain a strict stop loss of 110 and expecting a target of 145 on the upside.
Okay, Vijay, what would you recommend? Vijay, I think you're on mute.
Shimmy, sorry, apologies.
No problem.
I think
Go ahead.
So the kind of run-up market has shown, these stocks haven't shown any promise at all. Dishman Carbogen, I was going through the financials, and it has a stock price to earning of 95, a return on capital employed of 0.92, and a return on equity of 0.5. So I would like to inform, educate investors who get into companies. They should look at what are the earnings of a company. If the earnings are not there, the visibility of earnings is not there, and the price to earning is a very major thumb rule where people can easily check. It's available. Just put the name of the company and PE, you can check. So if you don't see a low PE, don't get into high PE companies. I would never recommend to get into a Dishman Carbogen or a Morpin. If you get any day into a company like Lupin or a Cipla, even a Dr. Reddy's or Divi's at these levels, these are great companies. So I would recommend that don't wait. There are lots and lots of opportunities. Get into some good cement company. Get into a Dalmia Bharat or an ACC, or maybe get into the logistics space. I think Adani Ports is a very good option to get into at this time. Even I see, I was listening to Baba Ramdev today, and I think even Patanjali Foods looks very good. So there are lots of good opportunities, good companies. Get into metal stocks. Get into a Hindalco or a Vedanta or a Tata Steel. These are companies lying, on the ground, and any day, I think on an annual basis they can give 20-25% returns. So I would recommend an exit in both the companies. Get into fundamentally strong, stable companies, and with a low PE and with a high earnings visibility.
All right, we're going to take a very quick break on that note. But as we do that, here's a quick reminder for our viewers. It's that time of the year again where Money Control Pro's Financial Freedom offer is back, and with added benefits too. So you can get a Money Control Pro subscription at net zero cost by claiming exciting offers worth 1,500 rupees from our partner brand. So grab the benefits now, only on the Money Control app or website. Hi, welcome back. You're watching Your Stocks. Our two experts, Vijay Chopra of EnochVentures.com and Ashish Kyal of Way Strategy Advisors, have been advising our viewers. And we have the next query coming in from Cochin. Sasidharan K is on the line with us. Hi, Sasidharan. Good afternoon. How can we help you?
Good afternoon. I have 30 shares of L&T, purchased 2 years back.
Okay.
How long should I hold it? Is it likely to go above 2,000, 2,100?
Okay. And you have one more stock, right?
Yeah. I have 30 shares of Colgate Palmolive, purchased 2 years back at 1,388.
Okay.
I want your advice on these two shares.
All right. Fair enough. Ashish, L&T and Colgate both, what is your advice?
See, I would first like to congratulate. I think 2 years back, if he entered at a very decent price in L&T as well as Colgate. And right now, we can clearly see L&T has continued to outperform sharply. The stock is quoting somewhere around 1950 levels, and it has moved up very decently. And the previous high, which was made as around 2080, I think that is going to be taken out by the stock. Continue to hold on to the stock. You can hold on for at least a year or 2 years as a long term. And you might expect the stock to go towards 2,500 or much higher levels. So looks very promising to me. As far as Colgate is concerned, there is a lot of volatility in the stock that we have witnessed when it went from 1,800 towards that 1,400. But the overall FMCG sector is just started outperforming, and I think you can continue to hold on to Colgate also. We saw a very good sharp rise from 1560 to around 1700, and now some dip is coming in. So continue to hold Colgate. The target on the upside is at 1820, and important support for the stock is at 1560 level.
Okay. Vijay?
I think L&T is a very long haul stock. I was going through some data and I have seen that the stock has been consolidating for over 10 years. We have not seen, this price was there, 10 years ago as well, 2012, 13, around this price. So I think that there has been a huge consolidation in L&T. I also predict that, there's going to be a lot of focus on infra space. So all the capital goods companies led by L&T would be beneficiaries. So there's a lot of road work which is going to happen. There's a lot of infrastructure work which is going to happen in India and abroad. And the credibility which L&T carries, the kind of, it's practically a zero debt company, being in infra space as well. So I think that L&T should, cross 3,000 if somebody holds with a longer term perspective. The other stock is Colgate. I always call this a portfolio stock, leave it for your kids. So this company would keep on giving you dividends and keep on increasing in price as well over a period of time. So no point of exiting a stock like Colgate. L&T is also a very long haul stock. Keep both the stocks in your portfolio. Don't worry at all.
Okay. From Bengaluru, Tarun Gupta has written in. He has 15 shares of Nykaa, bought at 1270, and 50 shares of Tata Motors at 390. Now he wants to know, should he remain invested? And especially he's concerned about Nykaa because he says there's been a decline since the IPO. So what should he do now? Vijay?
Well, I think that this gentleman can easily flip it to Zomato. I think Zomato looks much better valuation wise now, around these level 59.60, and Nykaa probably I think that it's still stretched. So if you want to be in the e-commerce space, so Zomato any day is a better option.
Okay, Ashish.
We can clearly see Nykaa has shown a very sharp correction. It has not even attempted to go on the upside and continue to trade below that 50 days, 200 days average. There is just no attempt of even breaking about that 20 days average. So it's better to be out from Nykaa. I do not see it crossing that 1500 mark. Looks like a huge resistance at 1500. So better to be out from this stock. And the other stock was Tata Motors. I think this is an excellent stock. You are getting it at a very good price at these levels also. We saw a very good move from 300 to 530 post that it is correcting in a time-wise fashion, not much of a price. And the auto entire sector, if you look at the cyclicality, it has turned on the upside. We can see the auto stocks are outperforming, and Tata Motors eventually should be able to cross even 600 levels on the upside. So continue to hold on to Tata Motors. On the downside, if you get any dips, use that as a buying opportunity. Target can be 600 plus at least on this stock.
Okay. The next query comes to us from Ratnagiri. Aruna Deshmukh has written, she has 40 shares of SBI at 430 and 10 shares of Kotak Mahindra Bank at about 1600. She's making small profits in both investments, but wants to know if she can remain invested for a further upside here. Ashish?
Yes, if you look at SBI, the stock is just breaking out on the upside after a brief consolidation. Looks excellent to me. The pattern target, if you look at the width of the pattern and measure it on the upside, that comes around 700 levels at least. So over near to medium term itself, we can expect SBI to reach those levels. And over long term, I'm optimistic about the stock. It is breaking out, and Bank Nifty is anyways outperforming. Kotak Bank has also a major hurdle at 1950, but I think it should cross over the next few days that level. And once it crosses that, we will get a classic breakout again on Kotak Bank. And the stock is very good from the long-term perspective. We can clearly see the long-term charts, the major support levels are intact, and this stock has managed to create wealth for its investors. So expecting Kotak Bank to reach towards that level of 2200 eventually, and much higher from there. And possibly if you get dips, you can accumulate more on this stock.
Okay. Vijay, what is your call on banks?
Well, I think that banking looks very, very good, and especially good banks like SBI, Kotak, even I see ICICI Bank and HDFC Bank. HDFC Bank post correction looks very good. SBI definitely, on the charts also it looks good, but I think that it can go up to 570, 580, and there, the profit booking is suggested. But there are smaller banks. I think that the likes of Bank of Baroda looks very good. Canara Bank looks very good. And the companies which are allied housing finance companies, Canfin Homes and PNB Housing, these look very good. Even PNB looks very good on the charts right now. So I think, all the major banks have already cleaned their balance sheets. So there's no overhang of the kind of NPAs they used to have. And their books are improving by the day. Their loan disbursals, now they are very vigilant on the books and the quality of the asset quality. So I would recommend that, one can stay invested in banking for at least 1 to 2 years time frame. And I see, again, I'm saying that, Nifty looks very good. Banking looks good. It's one of the, my favorite sectors for the next 2 years. So India would definitely be in a sweet spot. And if industry has to grow, if companies have to perform, they would need the help of the banks. And I don't see many, rate increases coming in the future policy. So there might be 1 or 2, rate increases in the credit policy. But again, banking looks excellent.
All right, gentlemen, thanks very much for joining in and for advising our viewers today. We'll wind up on your stocks. Thanks very much for watching. The team of Closing Bell joins you next.